Let's start our class. So good evening, everyone. Tonight, we're going to finish up with the statement of financial position part of group account with past questions. So basically, we'll just solve some questions from the ICAN past questions to round it up. And this will help us apply all the adjustment cancellation we have done. Like I've told you right from the beginning of this topic, I've told you that it's all about cancellation. When it comes to a parent preparing consolidated financial statement, it is all about cancellation. You want to cancel out similar items, and all uncancelled item should be consolidated. That is the whole idea behind consolidation. So let's look at this question. The last time they asked question on statement of financial position solely was in May 2024. And the question goes as thus. It says the following are the statement of financial position of Skoto Nigerian PLC and Niger Nigeria Limited for the year ended October 31st, 2023. So we're given the statement of financial position of the two companies. So now they give us some additional information. We're told that Shokoto Nigeria PLC purchased 70% of the issued ordinary share capital of Niger Limited 4 years ago. When the retained earnings of Niger Limited was 160,000, there had been no impairment of goodwill. For the purpose of the acquisition, plant and machinery in Niger Limited with carrying amount of 400 was revalued to its fair value of 480,000. The valuation was not recorded in the account of Niger Limited. Depreciation is charged at 20% using straight line method. Number three, Shokoto Nigeria Limited sells goods to Niger Nigeria Limited at a markup of 25%. At October 31st, 2023, the inventory of Niger Nigeria Limited included 360,000 of the goods purchased from Shokoto Nigeria Limited. Okay. We are also told that Niger Nigeria Limited owes Shokoto 280,000 for goods purchased, and Shokoto owes 120,000. It is the group policy to value NCI at fair value. Market price of the shares of NCI, non-controlling interest shareholder, shows before the acquisition was only applicable. We are now required to prepare consolidated minimum financial position as at the year ended 17 March. And you're also required to explain investment in a subsidiary should be accounted for in a separate financial statement of the parents. Okay, so we start with our workings with all the necessary calculations that needs to be done and adjustments that need to be done. We do it in our working. Let's pick them one by one. So usually when you have a question of this nature, you want to deal with and understand all adjustments required in all the additional information. Then when you do that, then you would have made some adjustments to most of the figures here. Ultimately, then before you then do your consolidation. Right, so this is just giving you a lot of information that's happening to these figures in the statement of financial position. So let's pick them one by one. The very first here is Shokoto Nigeria Limited purchased 70% in Niger. Okay, so that means NCI will be 30%. So, and the retained earnings of Niger is 160 as at the date of acquisition. That means this is the pre-acquisition retained earnings. And that goes to show that this Nigeria Limited retained earnings of 400,000, right? 160,000 of it is pre, right? That means 240 is post. But you know that the pre will be cancelled out ultimately. So there's really nothing to, I will just ensure I remember to update that when I'm canceling out. Number two, It says for the purpose of acquisition, plant and machinery in Niger Limited with carrying amount of 400,000 was valued to its fair value, and it has not been recorded in the books. Okay, I think we did this adjustment last week, and the position is charged. So let me start with that. So this is an adjustment relating to evaluation surplus. And the key thing here is this evaluation surplus here is 80,000. And apparently they said for the purpose of acquisition. So that means this evaluation was done at the date of acquisition. So the evaluation surplus is 80. Um, you can decide to just do carrying amount to just know what the 400,000 okay, 400,000 and the fair value was 80,000. So the evaluation surplus is 80,000. So apparently, this evaluation surplus of 80,000 um, is a pre-acquisition evaluation surplus. So it's like you're going to add to pre-acquisition evaluation surplus. The amount of these 80,000, and also you're also going to add it to your, which asset is it? Plant and machinery. You add it to plant and machinery of add it to plant and machinery of that company of Niger Limited, the same 80,000. That's one. Number two is that since it has not been recorded, now we have recorded it. That means there's a depreciation that should have been charged that hasn't been charged, right? And considering the fact that we acquired this subsidiary, when did we buy the subsidiary? 4 years ago. So we bought the subsidiary 4 years ago. So that means they have not charged depreciation for 4 years as on this excess. On this excess. So we need to do that depreciation. So we will need to charge depreciation that has not been charged. And that would be 80,000 divided by what's the useful life? Oh, it's 20% straight line multiplied by 20%. This will give me the depreciation per annum multiplied by 4 years. That would be the cumulative depreciation that has not been charged on these assets. So how much would that give us?
64,000.
How much?
64,000.
That's 64,000. That has not been charged on these assets. Now, this depreciation, how do you deal with it? You're going to deduct from plants and machinery, and you're also going to deduct from retained earnings of the guy with the assets, retained earnings of Niger Limited in the amount of the 64,000. So that's what you adjust for this this second one. That's the adjustment you made. So mistakes you might have made in the exam is, yeah, maybe you'll have gotten this correctly. Maybe you'll have gotten this correctly, this particular one, but the depreciation, you might not know that you're supposed to multiply by 4 years. That's the only mistake you might make. So just remember that since it has not been recorded at all, because that means the subsidiary has been carrying the asset at 400 instead of 480. So he would have undercharged depreciation on this 80 for 4 years. For 4 years since acquisition. So we need to charge all that depreciation. So it will remove it from the assets, remove it from retained earnings of the subsidiary. Now, that's done. Now, this one, intragroup sales of goods. The subsidiary, the parent, Shokoto, sold goods to the subsidiary in Niger at a markup of 25%. And at October 31st, 2023, the inventories of Niger included 360,000 of the goods purchased from Shokoto. So there is intragroup sales of goods. Intragroup sales of goods. I already taught you this, that when you have intragroup sales of goods, you will need to eliminate any unrealized profits that is made. And the unrealized profit that you eliminate is to the extent of the unsold goods, the goods that is still within the group. So as far as this is concerned, the group, the goods in there's still 360,000 worth of goods still in inventory. Still in inventory of Niger Limited. So we are going to eliminate the profit on that. So how do we eliminate this profit? We made a markup of 25%. So Sokoto sells goods to Niger at a markup of 25%. So, and this is 360,000. So there is a markup of okay, there's a markup of 25% that we need to, that's a profit on this 360,000. So if you do your calculation, or your calculator, what would that give us?
That's 90,000.
That is 90,000. So how do we eliminate this? Can anyone try? How do you remove these unrealized profits?
That's it from the retained earnings of Niger Limited, and we equally less it from the inventory.
That's correct. Okay. So why you
But
deducting?
sorry, I think it's Sokoto that sold
It's
the
from
good.
Sokoto Limited.
From Shokoto Limited. So you deduct it from retained earnings of Shokoto, the unrealized profits. You also deduct from inventory of who now? Of Niger Limited. The same 90,000. Okay. That's all for this particular one. Then this one.
Sir, sorry, sir, I have a
Sorry,
question,
sir.
sir.
Okay.
Yes, sir. My question is on the additional information number 3. So based on this 360,000, sir. So I'm a little bit confused because when I was solving the question on my own, I was thinking this 360 is the selling price that Sokoto sold the goods plus profit to Niger. So me, I was thinking I have to convert because that was how I solved it. So I don't know if, so I have to convert the markup to margin to apply to the 360.
That's my thought too.
Your thought is not bad. Your thought is not bad. So how are we supposed to do that?
Because the 20% that was given is markup, and markup is supposed to be on cost. So we are supposed to convert to margin. That's the 20% over,
So it will now
sorry,
be
25,
25 over
25
125.
plus 100, 25 plus 100.
1 plus markup.
Okay. I think I agree with you on this. I agree with you on this, but it can be a little misleading for us. So good you're able to spell that out. So since they told us that Shokoto Nigerian PLC usually sell these goods at a markup of 25%, so that means this inventory already includes a markup of 25%. I've marked it up by 25%. So why are you then changing it from, instead of 25% of 360, why are you doing 25 over 125?
To
Okay,
convert
so
it to margin.
okay, so well, I understand what you're saying. Now, from what they have said, at least it's good. That means some of you understand this already. For those that don't, they're actually correct. So we have to be very careful when it comes to this part of removing unrealized profits. So the examiner can tweak us with this. You would see that this guy he sells at a markup of 25%. And when you mark up, you will have marked it up based on, you will have added 25% on the costs. So if you want to get your profits, if you want to get it like this ordinarily, this 25% that I applied on this 360,000 will not work to get our profit because ordinarily they will usually, if you want to get profit, that means we have to look for the costs. This 25% can only go on costs because it is a markup. So then if you are now applying this 25% directly on selling price, you will not get the right profit. You will not get the correct profit. Because when they say somebody marks up, so that means that if you want to get the profit, is usually on the cost. Because that profit, they will just get, okay, what's our cost? Then they will add 25% of it to get whatever it is, the profit they want to get. Then from there, get their selling price. So if you want to get that profit, you need to know the cost. But now we don't know the cost. What we know is the selling price. And that's why Michael and Femi is suggesting that then, since if markup cannot work, that means we'll need to convert this markup to margin. If you cannot apply 25% on cost, then we'll need to convert this markup to margin. And how do you convert it to margin? So based on the corrections you guys have done for us, we cannot apply the 25% markup on the selling price. So this is because markup is only applied on costs. to determine profits. So we will need to convert the markup to margin in order to determine the profits, since we were given the selling price of the goods. So how do we then convert markup to margin? Now, since ordinarily 25% means 25 over 100, but this will have worked if we add the costs. But we don't have the costs. We have cost plus, what the examiner gave us is cost plus 25%, which is the selling price of 360,000. So in order to apply, you need to put this year is like 100 plus 25. This is at profit loading. So this 100 as a base will not work for it. So you need to increase this base to include the profit load. And when you do this, then you're applying, you're converting this margin to markup. So if you do this, what would that give us?
72,000.
How much?
Yes, sir.
72,000. So this will not work for us. So you guys are absolutely correct. So nice one. Okay. Now, having sorted that out and having learned that we can be tricked, as you can see, if somebody did not talk, I will have walked over it. Then the next additional information says that Niger Limited owes Sokoto Nigeria Limited 280 for goods purchased, and Sokoto Nigeria Limited owes Niger Limited 180. So what this is saying is this: in Niger Limited has a trade payables of 280. Sokoto Limited has a trade receivables of 280. They need to be cancelled out. So if they are intra-group, we cancel it out. And also, Sokoto Limited PLC owes Nigeria Limited 120. So Sokoto has a trade payables of 120, while Niger has a trade receivables of 120. They need to be cancelled out. So that means on both sides, we will cancel 280 plus 120 from receivables of Niger and also from payables of Sokoto. We're going to cancel out 400 from both sides, receivables and payables. You're going to cancel it out. That's what we're doing today. You just need to remember to cancel them out. Also, it is good policy to value NCI at fair value. And that was why they gave us this last point, where they gave us the share price of the subsidiary, just so that we'll be able to do this. And that is all. So no need for necessary details. So now let's go straight to our cancellation, which mostly results to goodwill. The first one is consideration transferred. How much did the parents pay for 1.6 million Sokoto paid 1.6 million to Niger. Then non-controlling interest. Since the parent has 70%, that means NCI has 30%. And since it's measured at fair value, how many shares did he acquire in Niger? Since they give us the nominal value, that means the total shares is 1,360. That's total value. That's total number of shares, 1,360. So multiplied by 1,360 shares. Then you multiply by the share price of the subsidiary, which is 1.50 naira. So the share price of the subsidiary is 1.50 naira. So if you punch a calculator, what would that give us?
Six
612.
12.
Yeah.
Sorry?
612.
Okay, 612. So if you add these two together, what do we have?
2212.
2212.
Cancel it out against the equity, net asset acquired. We'll have ordinary share capital of the subsidiary, which is 1,360.
1360.
Then you have pre-acquisition retained earnings, which I was given in the question as 160. Let's confirm. 160. And also, don't forget your pre-acquisition evaluation surplus, which is how much? Which is 80. If we add these three together, what does it give us?
1600.
1006.
1,600. Okay. So I take it out from 2212.
612.
612.
612. Number two, B. 1, 2, 3, 4. Number four is consolidated retained earnings of Sokoto and Niger. As per the question, what was the retained earnings of this is 1720 and this is 400? You remove Pre-acquisition retained earnings, which is 160. You have a balance, which is the post-acquisition retained earnings. And that's how much? 240.
240.
Then, from workings one, we said you are going to deduct 64,000 from the retained earnings of Niger, which is relating to depreciation that has not been charged. So you deduct 64 from retained earnings of Niger. Also, we say you are going to deduct 72,000 from the retained earnings of Sokoto for work is 2, which is unrealized profit. So we have 72 retained earnings of Sokoto. And that's it. So, having dealt with all of that, you can then get the group share in Sokoto's, in Niger's remaining profits. So let me do 240 minus 64. What does that give us?
176.
176. And he has 70% of 176. What does that give us?
That's 123.2.
Like this.
Yes, sir.
So what does it come to? 1720 minus 72 plus 123.2.
One 1771.2.
Okay. Then our non-controlling interests. What's the value of NCI?
12. 612.
612. So NCI share gets 30% times 176. What does that give us?
52.8.
52.8.
Okay. If you add it together, what do we have?
664.8. 664.8.
64.8.
Okay. So Sokoto PLC, we have consolidated statement of financial position as at year ended when? October 31st,
About
2020.
2020.
Okay. So what was the first item there? We have
The
plant and
plant and
machinery.
machinery.
Can you add these two together for us?
3160.
3160. Then I want to check adjustments. We say you are going to add 80 to it. And also, we say we're going to deduct 64 from it. And that was it. So what does this give us?
Three one seven six. 76.
Then the 76. Okay, yeah. That was what I wrote. Then the next item is
Yes, sir.
furniture items. This 2000. Furniture and fittings 2000. And the next item is investments, which was cancelled out against the equity. So resulting in a goodwill of 612. So let's have goodwill of 612. Then our inventories under current assets. Inventories. What's the addition of these two? What was 1760 plus 560?
2320.
2320. There was an unrealized profits here.
52.
Of 72. So how much do we have?
Two two 2,248.
Then we have three receivables. What the addition of these two?
Two thousand.
2000. And remember, we need to cancel out 280 and 120. So can you add these two together for me? What's 280 plus 120?
400.
400.
400. We're going to do the same thing in trade payables. Then we have cash and cash equivalent of 800. So what's my total assets?
Ten, 4, 3, 6.
Sorry?
10, 4, 3, 6. 10,436.
Then our equity and liabilities. My equity. I will have my ordinary share capital, which will be the ordinary share capital of the parent, which is 56. Then the next item is retained earnings, which I've worked out here,
71.2.
which is 1771.2. Then, after your consolidated retained earnings, before we move to liabilities, we need to bring in NCI, which is 664.8. So, can you add together this equity? What does this give us?
Eight, 0, 3, 6.
Sorry?
8036.
8036.
Okay. Then my current liabilities. I have my trade payables. So can you add this together? 2640, I guess.
2640.
Okay.
Minus 400.
Okay, don't let us forget. Minus what? 400, Abby? The same 400 we
Yes,
deducted
sir.
there. That is 2240, Abby?
Yes, sir.
Then bank overdrafts, which is 160. And that gives us my total equity and liabilities. And what does that give us?
10, 4, 3, 6. 10,436 naira.
So I don't think there's anything out of the ordinary here that we have not looked at. Just like this one, just put all of them in a place. So we just, and let's always remember that when we were solving this in class, we almost omitted it. Then we were corrected. At least when you get to exam hall also, you should be able to then remember that this 25% was a markup. You cannot just apply 25% on the 360, except if the 360 was cost. So since 360 is with profit loading, that means this 25 will be 25 over 125. We need to include profit loading on this base also, just so that we are comparing like we like. So doing that means you are converting this markup to margin. That's what it means. But every other one is their normal things. Any other questions? Let's look at this. Let me forget. They said, explain how investment in subsidiary should be accounted for in the separate account of, yeah,
Sorry, can you allow me to say something?
okay,
I'm so sorry. I want to disagree with that calculation on the markup, the
okay,
goods sold, goods sold. The question says, Sokoto Nigeria Limited sells goods to Niger Limited at a markup of 20%. Then, at the consolidation date, Niger Limited, the inventory of Niger Limited included 360 of the goods purchased from Sokoto. Now,
okay,
based on what you have calculated here now,
okay,
you will agree that Sokoto sold to
to Niger.
Niger Limited. Niger Limited, good. Because it is 360,000 naira. So based on what you calculated now, you consider that 360 to be the selling price, Abi?
Yes, it already includes the 25%.
Can you allow me to say this, sir?
Okay,
Since they said included in the book of Niger Limited at 360, and for it means every inventory, based on what I know, every inventories are recorded in the books at cost, not at selling price. It is when it is converted to sales that we have the sales at the selling price. So this 360, I want to assume, I want to believe, and I want to conclude. I want us to look at it very well. Since it is included in the inventory of the buyer, it is inventories are stated at the cost price in the book, not the selling price. So this 360, I want to assume, I want to agree that it is the cost price, not the selling price. So we should leave it at that markup. It should be 25 over 100, not 125.
okay, no problem. So nice suggestion, yeah. So before I respond, let me allow Michael to talk as well. So let's share your own opinion too.
Okay, so sir, I just wanted to responded to what he said last, that the inventory was at cost. So it means that at cost, because Niger Limited bought it from Sokoto. So to Niger Limited, that is the cost he bought it, 360. But Sokoto to Sokoto now is he has added profit to the cost he got it. So definitely, Niger Limited we report what's it called, the inventory at cost, which to Sokoto now is cost plus profit that he already sold it to Niger.
Mr.
Um,
Wasil, sir.
is that acceptable to you, Latif?
No. The only way out that I would take is your final resolution, your final statement on it as a lecturer. But
Sir,
however, can you please look into the past question, the solution in the ICAN pack? Let us see what they have there. Is it 72, or is it the cost price they stated, or the selling at or markup or at margin? Is it 71? Is it 120? Is it 25 over 125 they use, or 25 over 100? Let us see that. Well, that is our institute.
sir,
No.
Hello, sir.
if I may
I,
chip in something, sir.
I have
Okay, sir.
this.
No, before you talk, let me quickly correct that notion that whatever solution I give to you here supersedes whatever it is in the ICAN pack. So, and that's, if you check it very well, I can usually do a disclaimer and they make mistake from that solution. So I won't say it's an insult, but to a large extent, it's an insult to me. I don't go to check the solution on anything I do for you because it's principle. If I'm teaching you principles and we cannot apply it in any of their questions, we are the one that provides solution to them. We are the one, and there are mistakes in the solution. So I'm not going to check the ICAN pack to confirm whether my solution is right. Then I'm not qualified to be teaching you. So if you want a rational discussion based on what we have taught you, fine. If you don't want, if you just want to go and copy ICAN solution, then that's also another approach you can use as well. But I'm just trying to listen to you. I'm just trying to make us learn. But this is a learning process for you guys. So don't suggest that we should go and check ICAN solution. Please don't suggest that again in this class for us.
Noted,
Okay,
sir.
so Femi, yeah, I'm with you.
Okay, sir. So what I wanted to chip in is that whenever a good is the cost of a good is arrived at, whenever we see in a question that there is something either markup or margin, it means that something is added to the cost to get to make it to sell it. So if it is margin, so it is normally that margin is normally on sales, and the tradition is that when you now see margin or markup on sale, it is ideal that you convert it to margin. And whenever you see markup on on sales, you convert it to margin. And when you see margin on cost, you convert it to markup. So this Sokoto now is selling the goods to Niger. Now this is a group account, and they are not supposed to even make profit from selling it to each other. Now, if I'm selling it to Niger, Niger is not selling it back to me. He's supposed to sell it to outsider, where the profit will be realized. So, but in this case now, the good is not being sold, and they are not supposed to make profit from each other. So, since the good is not being sold to outsider, because they are supposed to be a one entity. Now, since this good is not being sold to outsider, it is normal that we now remove that gain, that markup gain that is on that sales that they are sold to Niger. So that's why we have to remove the cost, because if I'm selling it to 360 to you and you are selling it to 360 to outsider, so what are we now making profit? Where do we make the profit from? So I think this 360 it included element of profit, and it's not supposed to make profit from each other. So that's why we have to remove the markup from the cost, this cost, sir. That's what I wanted to say.
Okay, so good opinion from everyone. So the argument is simple here. We were told that Shokoto Nigeria Limited sells goods to Niger at a markup of 25%. At a markup of 25%. And let me quickly correct a notion that Latif mentioned, that all inventory are at cost. No, they are not. Okay. According to IES 2, I think I'm not taking you guys on IES 2. So inventories are measured at the lower of costs and net realizable value. Okay, at the lower of cost and its net realizable value. So don't assume that that inventory are always at cost. So it depends. But that aside, it's clear. This is quite very clear, because Shokoto, anytime he wants to sell to Niger, he includes profit at 25%. So we're now told that the inventory of Niger included 360. So nobody needs to tell you. Before you know, when the examiner already told you that whatever this guy is selling, he has already included profit. So why are you now saying this 360 does not include profit? Of course, it includes the profit. So if you now want to calculate the profit on this place, you now do what we did initially. we do 25% of 360, we'll be wrong. Because 25% of 360 is 25 over 100 times 360. So you're assuming the 360 is cost. You'll be wrong. So when Michael said, okay, let's convert it to margin, I was happy because that means I needed that discussion so that we would have this understanding. Then, of course, I outrightly agreed with Michael that yes, you're correct. Because this 360 is selling price. This 360 includes 25% already. So you cannot do 25 over 100. You have to make the base also 125. So some people say you are converting markup to margin. That's fine. But I need you to understand it very well that all we are doing, that was why I intentionally left my solution this way. So I didn't emphasize, you are converting markup to margin, whatever, even though I wrote it here. But I need you to understand that this 360 already includes profit of 25%. So you cannot say 25 over 100 times 360. So you're assuming that this is on a base of 100. But this 360 includes profit of 25%. So for you to get out the profit, it will be 25 over 125. Like you are bringing it to the base of 1. So it's like 360 over 125. That will give you per each one. Then you multiply by the profit element by 25. Then that gives you the profit inside this 720,000. So Latif's argument is simple. His argument is that this 360 is cost. That's what he's saying. That this 360 is cost. No, this 360 includes 25%. And it's very clear from here. Okay, so it's still a good discussion. I like this kind of discussion because it makes us explain these things better like that. So to a large extent, we might have gained one or two things. But again, I would strongly advise all of these things. I have all the solutions to them. I've of course solved it myself before. When you solve it, share it with me. I will send you the solution in line with the way I've taught you in class. In line with the way I've taught you in class. So, like all this, of course, the other ones I was asked to go and solve it yourself. When you solve it, send me the solution. I will send you the one I solved in line with the way I taught you in class so that you understand it very fast. If you go and sit with the ICAN pack, the way I solve my cancellation is different from the way they do their own. You spend a lot of time, hours, trying to figure it out. It's different. The way I do my own, they don't do deduct, add, they don't do that. You see them doing debit this, credit that, credit this, credit that. Everything is scattered around and all of that. You spend a long time trying to examine the solution. And don't always run to solution, just solve and see if you are correct or not. Share with your lecturer to help you check. And that would help you. And from experience, it makes you pass your exam very fast. Now, this one, in November 2022, it says Food PLC has a subsidiary, EBA Limited. The statement of financial position of the companies as at September 30, 2020 are presented below. So we're given statement of financial position of the two companies as at September, and we're given some additional information. The additional information one was that Food PLC acquired 480 million shares in EBA 2 years ago when the balance of retained earnings of 60 and 40 respectively. So they give us the pre-acquisition retained earnings, pre-acquisition general reserves. That means they'll be cancelled out, right? So they didn't give you the percentage holding. They gave you the number of shares Food acquired in EBA. That means you will need to do some calculations yourself. You will need to do some calculations yourself. Okay, this is getting interesting. They now said the fair value of NCI at acquisition is 150. So they gave us the fair value of NCI directly. Okay, simple. Also, they said during the year, goods costing this to Food was transferred to EBA. Is the policy of Food to transfer at a cost plus, fantastic. The same question. Is the policy of this guy to transfer at cost plus markup? Then I say a quarter of these goods have been sold by Eba. Now, I don't plan to solve this question for you. I just want to discuss, then I will give you an assignment to solve yourself. But because we have had a prior discussion on this before, because we have had a prior discussion on this before. Now, can somebody tell me? I think this one is more straightforward anyway, because they told us goods that was costing 80 to was transferred. Okay, I think this is straightforward. So what's the unrealized profit here? Let's assume this one is not there. Let's assume this one is not there. Let's even assume it's there. They said a quarter of these goods have been sold by Eba. Who can tell me how do we get the unrealized profit here?
The unrealized profit will be 25 over 100 plus the additional 25 that was there, multiplied by that's the 80,000 times, since it's 1/4 that was sold, that will now be 3 over 4.
Fantastic. Fantastic, Lukman, but you're wrong. You're wrong because you said 125 over 100 plus 25. Abi? Is that what you said?
I think
Yeah, I
this
think
one is cost
Yes,
plus.
it's cost plus.
This one is not selling. It's transferred to at cost plus. Cost plus. Cost is cost. When we hear cost plus, that's markup already, and it's on cost. That's direct. This one
Oh,
is
yes,
direct.
yes, that's true.
yes. So Lukman, this one, this one does not include the 25% yet. The examiner did not give us, the examiner said good costing 80 to food. So they already gave you the cost. So you don't need to, when you are doing your profit, that means you can easily do 25 over 100 times 80 because this 80 is cost, is at 100. It's not the selling price. It's different from this, that they gave us the selling price. They didn't give us the cost. They said Shokoto sells at cost plus markup. This one is also the same thing as cost plus markup of 25%. They now gave us the amount of the goods in the inventory of Niger. Remember that Shokoto will have sold it to him at cost plus markup. So this 360 already includes the markup. It includes it already. So that was why we did 25 over 100 plus 25.
Oh, I know where we got this thing why Mr. Latif was arguing. Assuming the cost was given to us from Sokoto, we will not be doing all those conversion. But the cost was
Exactly.
given to us from the book of the subsidiary, which is already having the element of the um, profit. Yes. Thank you.
Exactly. That's one way, but don't conclude that if the examiner tell us that because if in the books of Shokoto 2, it might also include it. It depends. Don't conclude. They can structure the question in any way. If the examiner tells us that, whether it's the book of whoever, if they tell us that is the selling price, then that means you still have to do the same thing. You still have to do 25 over 100 plus 25. So don't let us generalize so that you will not fall into a trap. This one, it's always clear in the exam. You always see it, whether it's cost or whether it's selling price. This one is cost. So this is the cost to food. So whatever it is that is the selling price, you will include it at the end of the day by the time it makes he sells it, he will have included the selling price in the books of Eba Limited. But I mean, they told us the cost. So it's simply, you can easily do 25% of 80 to get your own realized profits. And since 1/4 have been sold out, that means only 3/4, 3/4 is what is in inventory. So it's 25% times 80 times 3/4. That's what will happen eventually. Now, the next one, it says part of the bill receivable have been discounted. Now, this one means that I'm not sure we mentioned anything like this. So I don't know if you have gotten this, maybe residual knowledge from your general knowledge. So when they say a bill receivable has been discounted, so this is very similar to factoring of receivables. You factored your receivables. So which means that somebody is owing you money, you have a receivable. So Food PLC has a bill receivable. So of course from maybe its subsidiary, and maybe he needs money, and this other guy is not ready to pay him. He's not ready to pay him, so you can discount it. Discounting means that, let's assume the face value or the money is expecting is 100 million. So you can just go and meet somebody like a discount house or a factor, whoever, that okay, somebody is owing me 100 million. Okay, so can you give me 80 million cash because I need money now? Then when the person pays me, I'll give you the entire 100 million. So what he has done is he has discounted the bill because he needed money urgently. So he needed to look for a way to discount the bill to get cash. Of course, which will be lower, but I mean, he will have met his liquidity needs, and whatever it is that is on it will be the profit of that other guy. And if you look at the statement of financial position, graciously, there was bill receivable of 30. And on the other side, there was bills payable of 40. There was bill receivable and there was bills payable. So what that means is that this one says that I'm going to pay you 40. While this one is saying I'm expecting only 30. Now that's because he has gone to discount some of it. So, which means that this other 10 is owed to outsider. So, I mean, if you don't want to think too much, just when you're canceling out, whatever is remaining, you consolidate. I mean, that's the easiest way you can approach this. Whatever is remaining, you consolidate. So you cancel 40 against 30. So this goes off. The 10 remaining here will be consolidated. But the examiner is just trying to explain to us why they are not the same. It's because food has gone ahead to discount the receivable. And that's the treatment for that. Additionally, we're told that the sum of 8 million transferred by EBA to food as part payment was received after the reporting date. So that means there is an 8 million that is a cash in transit. There is an 8 million that is a cash in transit. And I think they should give us a clue here. I think it's this. There's due from EBA of 20 and there's due to food of 12. So by the time you cancel out this 12 against this 20, the balance of 8 would be cash in transit. So you're going to consolidate that. Okay, I can see Femi's hand up. Please go ahead, please.
Yes, sir. This issue of bill discounted, since it's food that is discounting the bill. I'm thinking that we are supposed to deduct it from his. I'm just thinking, maybe that's how I would have approached it in the exam, like from his own retained earning. Will it be okay since it's food that is discounted? Is not the bar.
Okay. So, why do you want to deduct from retained earnings? And how much do you want to deduct from retained earnings?
Since he has discounted the bill, he's supposed to collect 40,000, but he's collecting 30,000. The difference, I will just like net it off from his own retained earning. Now I'm just thinking, no, maybe it's a good approach.
No. It's far from good. It's so bad.
Hey,
Why you don't deduct it? It has nothing to do with um retained earnings. It has nothing to do with retained earnings. It has so much to do with the fact that you will pay somebody from outside eventually. When he collects the entire 40, he will just settle up with he will settle the person. And again, um, when it comes to cancellation, just cancel. You cancel the two. Cancel this. Cancel this. Whatever balance consolidates. So within earnings does not even come in here. It's really, I mean, items that go to P&L are clear, like depreciation, unrealized profits, impairment of goodwill. Those ones are, but when it comes to cancel, anything, any balance consolidates. So even if they didn't even give us this note, the examiner is even, you can even close your eyes to this and assume it's not even there. So by the time you see bill receivable 30, bills payable 40, they are not the same. You cancel whatever balance consolidate the remaining 10 because there will be a balance of 10 from the payable side, consolidate. So the examiner is just magnanimous enough to explain to you why they are not the same. It's because this other guy has gone to get some money. So he has gone to get some money. He has gone to go outside to get that money. So this 40 is owed to outsider, not food. So what food is expecting from this guy is just 30. The remaining 10 is owed to outsider. So you can consolidate that. You can consolidate that. So you cancel the two.
okay.
Keep it simple, please.
Thank
And
you, sir.
again, this one also, even if they didn't give me these notes here, so you just for you to cancel out this, since they say due from a bar and due to food, whatever balance consolidates. But the examiner is nice enough to tell you that the remaining A2 is cash in transit. It's because this guy has sent money, but this guy has not received it. That's why this guy is insisting that you are still owing me 20. So there is 8,000 that is uncompleted. So 12 against 12, whatever 8, consolidate. Keep it simple. There was an impairment of 16,000. So this one we did and we solved the question on impairment. So whatever goodwill you get, you remove 16,000. Then this 16,000, depending on how NCI is measured, since NCI is measured at fair value, that means this 16,000 will be deducted from retained earnings of the subsidiary because that means NCI will also have a share of the goodwill. So whatever impairment should be shared between the parent and the subsidiary and the NCI, I mean. So this 16,000 will be deducted from retained earnings the of the subsidiary. They also give us carrying amount of net assets is 20. So this one is that fair value adjustments. We did it before. So this one is relating, they didn't tell us the particular is relating to a machinery. So in this case now, the carrying amount is more than the fair value. So this is a fair value deficit and is a pre-acquisition one. So, pre-acquisition reserves, in this case, pre-acquisition fair value deficit, it will come in as a deduction from the equity of the subsidiary when you're canceling out, right? And also, that means there will have been an excess depreciation. So we'll do 15% on costs. So that means they have overcharged depreciation that you will need to add back on this depreciation. I've done something like this, but this is now not surplus, this is deficit. So probably do a reverse adjustment. Also, they now give us the nominal value of the shares of food is 50 kobo, EBA is 25 kobo. Now, this one is going to help you determine the number of shares that they have. Because if you don't know the number of shares that EBA has, you would not know the holding because they told you the number of shares they acquired. So let me see how you're going to adjust this. So I won't do this because there's nothing new here. So I think let me allow you guys to attempt this question so that we'll not just be repeating almost the same thing. And this is talking about explaining gain on banking purchase and all of that. So try your hands on it. I have all the solution. I've solved all of this question exactly the way I've taught. Let me show you. So I'm not going to, I won't solve it for you again. I'll allow you to attempt it yourself. So when you attempt it, then I will then share the solution with you. Let me show you.